Analysts are digesting earnings from a couple of tech giants. Both Apple and Amazon reported after the bell on Thursday. Apple cautioned that costs could rise by some $900 million US. Amazon's quarterly outlook was seen by analysts as cautious. Let's get some perspective from an expert. He's Gil Luria, senior software analyst at D.A. Davidson. Gil, let's start with Apple's. iPhone sales in China have been a concern for a while, before tariffs became perhaps an even larger concern. What's your take on the Apple numbers today?
They were fine. The March quarter was fine. Even the guidance for the June quarter is fine. It's really the company's inability to provide granular guidance and to make any statements beyond the June quarter that have investors pulling back a little bit. Having said that, Apple stock has held up pretty well, and that's because investors are mostly looking through this year. This year is going to be a tough year because Apple's going to have to do a lot of adjustments in its pricing, in its vendor management, in its supply chain, and they still were able to deliver a good March quarter, an okay June guidance. And so investors will look through it. They would just like a little bit more visibility. I'm not sure Apple's in a position to provide that visibility right now, given the shift in tariff regime, and that we really don't know what the outcome is going to be for all those bilateral tariffs. Once we have that visibility, Apple will be able to extend its outlook beyond the June quarter.
The company seems to be taking early steps with respect to tariffs, moving more iPhone production to India and pledging to source chips from Taiwan Semi in Arizona. Does the market want to see those things play out to completion?
Very much so. In fact, the shift to India was very impressive. Apple was able to really change the way it ships phones globally in order to circumvent some of these tariffs, or at least some of the higher tariffs. So instead of shipping globally from India, they're now taking the entire supply from India and shipping it to the US, which satisfies more than half of our iPhone demand, and then shipping internationally from China, where tariffs haven't changed. So that's a very clever workaround they've had. The hit to costs in terms of the next quarter guidance is only $900 million, which sounds like a lot, but it's not that much for a company with $400 billion of revenue. And so as long as that's the level of impact, as long as they can continue to move the supply chain around to get around the impact of higher tariffs, they should be fine. But we don't have that visibility yet. We don't have an agreement with India or Vietnam, the two main countries. And we certainly don't have an arrangement with China yet in terms of the long-term outlook for a relationship between those two countries. And Apple has done a masterful job of navigating those relationships, that very tense relationship between China and the US. But that's not to say that they'll be able to forever get away from catching some of that crossfire as we continue to decouple from China.
The company says, as we noted, it sees $900 million US in additional cost coming in the third quarter of 2025. How material will that cost uptick be to profitability and margins?
It's negligible. And if that's all it is, investors will be very relieved. The concern today is, does that get worse in the balance of the year if we don't have arrangements with India, Vietnam, if we continue to escalate with China? Then the impact could get worse into the balance of the year and into next year. But if we just settle into a good arrangement with India and Vietnam, don't escalate further with China, we should actually see that number go down from there. And by next year, we should be fine. And that's great because we're likely to get the upgrade cycle we've been waiting for iPhones next year, as the AI functionality that we were hoping would drive an iPhone 16 upgrade cycle has not materialized enough. There's a chance that it becomes more material into next year. And if everything's settled on the supply chain for next year, that sets Apple up for a better year next year.
Okay, you've got a buy rating on shares of Apple and a price target of $250 US, actually been increased today or yesterday. On Amazon, you also have a buy rating and a price target of $230 US. What do you think of the Amazon numbers?
that it was also not as bad as feared. Again, most of their businesses, at least dollar-wise, is retail. So their retail business did well. The profitability there was fine. Again, the March results were good, and they're heading into this more challenging period in okay shape. Really, the one place where you saw their caution around where the consumer's headed is in the margin guidance for next quarter, which was below expectations and quite a big range. What that tells us is Amazon has decided to do what Amazon does, which is focus on making the consumer happy. So to make the consumer happy, they want to make sure the consumer has everything they want to buy at the price they want to buy it and delivered to them quickly. And if that means a quarter of lower margins, Amazon, as it has been, is willing to do so. So we heard that. On the AWS side, we got 17% growth. That was about as expected 2 days ago. But since Microsoft Azure reported such spectacular growth a couple of nights ago, 35%, then that 17% from Amazon just came in a little bit not as exciting as Microsoft. And that was a little bit of another slight disappointment from Amazon. But we're heading into a difficult period for Amazon, as we are with Apple. But we're doing it from a good position, both on the retail and from AWS.
Gil, thanks a lot, as always, for joining us with your expertise. Gil Luria is Senior Software Analyst at D.A. Davidson. Up next, we'll speak to